And I'm making a habit of this being live on Inside the War Room. I haven't done this very often, but here I am once again, Ryan Ray, as always, with my good friend Mark Rossano. Back, Mr. Rossano, the last time you were on, you were actually on back-to-back times because I was moving and I was out of the fray for a while. I think I put in 14 episodes between your last monthly appearance and this one, so I upheld my word, and we got some episodes in. It's good to get you back, though. You are one of the favorite guest of the program. So it's good to have you on, sir. How are you doing?
It's a pleasure. Thanks for having me. Yeah, it's always, always good. There's always something different happening in the world as everything starts to sell off a bit after China has and Asia has struggled, but the U.S. markets have been holding and pretty strong at this point.
Okay, we had a little Twitter kerfuffle. I don't know, last Monday maybe something like that. But I sent out a tweet as you had a slight sell off in oil. $3 to $4, whatever it was. And I sent out something about you and Big Warren taking a victory lap. And people really got all up in arms. I don't think people really realize I don't care when the price of oil moves $1 or $2. Like I really like a scale of 1 to 10, it's a negative 4,000. I literally care less when the oil goes up $2, when it goes down $2. I don't care at all. It really means nothing. For anything that I do or anything that I follow. I'm not a trader. It's just okay. It's just an observation. I thought it was kind of funny. People take it. It's so funny though. People take it so seriously that man, the price is up. And then you had people come in saying that for 18 months people have been saying this and people have been saying that. And can we all just lighten up on Twitter just a little bit?
It's just funny because one of the things that I always try, and for those that watch my shows regularly know that I'm very clear when I talk about how there are two markets. There's the paper market and there's the physical market. And at times they can disconnect. At times they can come together. More often than not throughout my career, they've been closer than they are today. Mm-hmm. But just because something fundamentally may not look correct, and there's going to be some gravity bringing it or keeping it where it is, doesn't mean that I'm very clear. I don't give positioning. That comes into a whole different compliance world. But there's always these assumptions that I'm a perma bear, Big Oren is a perma bear. I'm not. I'm just looking at fundamentals, showing where the physical market is. But it doesn't mean that I'm positioned that way. I'm always moving around because I do trade this. These are things that I am taking advantage of. And, one of the things for anybody who's been watching, I've been very adamant about what I thought about China, what I thought about Asia in terms of growth. And, you're starting to see that play out in their equity markets. And again, that just, if you look at the physical market, what the spreads are telling you, what the refiners are doing over there, and now what the equity market is telling you, you kind of are starting to see this breakdown. Not to say that the U.S. isn't going to be, the prettiest girl at the ugly ball, but it's just going to be a very different world in terms of when do things start to snap back and we start to see a bit more connection. Because that's one of the reasons why I've been more active in grains. I think grains make a lot more sense just because the paper market is trading closer to where I believe the physical market is. As we continue to have, as we were talking before, you hit the go live button. We were talking about, some of these floods, some of these droughts, some of the things that are impacting, key areas in Germany, in China, and some of that fallout. But it is funny, people. But it's fun. It's fine. Everybody can throw shade. Everyone can have their opinion. That's cool. That's what makes a market. That's why you have people buying and selling. Sometimes I would be more apt to be on the downside, here. But I said that right after when we spoke on the Monday following 4th of July, and there was a big sell-off because I don't think people appreciated what OPEC means, where this is going to go from here. We're starting to see some of that softness in demand again, which is showing up in the forward physical market. But again, as the saying goes, the market can stay irrational longer than you can stay solvent.
Well, so the one thing I've learned, I've done oil and gas podcasts, close to probably 500 now. I don't know. We've done a couple hundred Texas oil and gas podcasts, and maybe it's 300 or 400. I don't know. It's hundreds of podcasts.
Right.
And so here's what I learned a long time ago. My perspective on the oil and gas industry is coming from a service side perspective, right? People who work for the people who do the work.
Mm-hmm.
Okay. the price moving $1 or $2 literally means nothing to me because, unless it's like, 50-49, and you're like, oh, okay, well, but if it goes from 62 to 63 and back down to 61, service companies, by and large, don't care.
No.
And so
EMPs don't. I mean, there's gyrations. That's it. There's always been gyrations.
Right.
I mean, I've been in this market for over 15 years. It gyrates. It is what it is.
Right. Now, if you're a trader, maybe you made a bunch of money on that move. Maybe you didn't. Whatever. But it's so funny because people take the price and how the price moves $1 or $2 or $3, and I'm like, there are hundreds of thousands of people around the world working in this industry who literally could care less if the price moves at all. But if so anyways, I always find it fascinating because the trader side is so aggressive on the pricing and where it's going. And the reality is, if any of us actually knew, we wouldn't be talking about it.
Absolutely.
That's the thing. None of us know. We're talking about the things that we're looking at, what we think might happen. But even if you took, so first off, no one can reasonably understand all of the data, because when you get down to all of the data, there's all kinds of demand metrics today. But even if you could, you don't know what's going to happen tomorrow, because tomorrow, who knows what's going to happen? You could shut down, you could have expansion, war break out. So you don't. So even with that, so it's all these things, and it's just, I don't know. It's the pricing people. I'm fine with predictions. I think they're great. I think they're actually great to make, because you can say, I think the oil is going to be here because of these 5 factors, and then if you're right, this is why I was right. You could be right because not because of those 5 factors, because something else that you didn't think about. Or you could be wrong, and you could say, okay, this is. But we've gotten in a world where just making predictions, talking about stuff is so crazy. It's so funny because I don't come from that world at all. So just to see people getting all up in arms when you sit out of this kind of a harmless tweet, it was quite amusing. So I enjoyed it. Sorry if you took the brunt of that, but it was fun.
I know it's fine. I mean, I'm used to it. It's funny just because when I look at what comes next, I like to look at the economic drivers as well. You have to have a conversation of, well, what are wages going to look like? What are prices going to look like? Unilever was the most recent to talk about taking their prices up, 10 to 15%. So between Procter & Gamble, Kimberly, and Unilever, that's literally your everyday items, like things that you buy day in and day out, week in, week out. They make that stuff. And that is, I think, going to be much stickier and more problematic, especially as you see the excess unemployment starting to expire. You're going to start to see that people are going to have to accept the jobs that are being offered, because they're being offered the jobs. But one of the slides that we used on the show talks about how the biggest issue right now outside of skills is right now skills and wages. That's where the disconnect is happening. You have people trying to leave industries, go into new industries, and the companies are like, look, I know there's a lot of people unemployed right now. I'm going to wait. You don't have the skills that I want, and I don't really want to train you because I have a backlog and I don't have time. So, but if I do have to train you, you're going to have to accept the lower wages. And then on the person's side, they're sitting there going, well, there's a lot of jobs out there, so I'm not going to accept these wages. Right. So there's this standoff, and there's going to be a meet in the middle. But it's just going to take time. And as you come to the other side of this, it's just going to be difficult to see, as prices remain sticky, that how are they going to react? How are they going to spend? How is spending going to, we saw it today in durable goods sales, but not to say that that's surprising, because we've been talking about the shift from durable goods to services. But that flash PMI number was a bit alarming. It was still expansionary, not saying it wasn't, but you're starting to see things cool off. And I think that's going to giving some mixed signals when you start looking forward to, well, what is that second half going to look like? What is 2022 going to look like? And I think those are some real conversations that have to be factored in when you're talking oil and gas, when you're talking, gasoline, diesel, jet fuel, because I think that's going to be a big driver on the over the next, let's call it 12 months.
It's funny you talk about the job market. I was at church on Sunday, and a guy works for, I think they do custom made cabinets. So all the houses being built and remodeling. He said that they have, so many positions they can't fill them, and they're always putting out asking for people. And he said on the most recent post, they had 100 or 150 applicants come in. Only 2 people actually showed up for interviews. And so, whatever the number was, 100 or 150, whatever it was, 98% of those people were just sending in the the application so they can keep getting their unemployment benefits. And to your point, that is part of the thing you're trying to measure, which is these people who aren't getting jobs, but they claim they're looking for one. But then there's all these open positions. Well, these people don't even want a job; they just want to keep getting their unemployment benefits, regardless of what the pay is.
And to that point, I think it also has to be considered now how easy it is to post a job and how easy it is to apply for a job. Like I mean, I've had to apply for jobs in the past, and when you have click here for quick apply, like, and all of a sudden, once you build your resume, you might have 3 or 4 cover letters. It's just drag and drop, and all of a sudden, within an hour, you've applied to 15 jobs. And I know from my own experience that you go through this process, and then on the other side, it's it was hired internally. There's a freeze on this position. This position has now gone away. And it's like, okay, well, why did you interview me for 6 weeks? Why did I have 4 rounds of interviews if this job didn't really exist? And they might be just testing the market. Like, how much interest is there? To make sure that they're paying the person that they already slated internally to hire. What are you going to pay them? Well, let's go test the market. And then there's also laws where you have to make sure that this isn't nepotism. So you have to have things posted for X amount of time. You have to interview X amount of people. So it's always frustrating because you never know like what is real given the ease and some of the legality, like you pointed out, with to get your unemployment benefits. Are you looking for a job? Prove it. Oh, I just applied for 10 jobs. Here you go. And it's like, that's 10 clicks.
Right. Well, and yes, agreed. And the other thing is, I hate giving Big Orange credit here, but we'll give Big Orange credit. Back before the pandemic, this is 2018. This has been a while back. Amazon had, I don't know, 5,000 jobs or something for some kind of engineer, whatever. It wasn't a worker, a factory worker. It was more of a high-end job. And there was a big debate over college degrees and people being qualified. And I'm pretty sure it's Big Orange. And he was like, guys, Amazon doesn't have whatever this number was. Amazon doesn't actually have this many positions open. What they're doing is they're going out there, they're putting it out there. They're looking for high qualified people to come in. If they get it, great. If not, they leave it open. And his point was to your point, which is, it's not like you're running a classified ad on the Sunday paper and it costs a bunch of money. Right. You just put it out there. It's free. Amazon has a website. They can put them up there literally whenever they want to. And so you do see a lot of that going on as well. Okay. So I am curious. I think maybe we talked about this. I don't know. At some point, I think even the most ardent person of how great the economy is, we have to have some kind of reset. Like, that's just inevitable. My read is, talking about unemployment, that's where we would see it at. So you won't have, so you take like the housing crisis in 2008, where you see the rates go up, people can't afford it anymore. Well, if you got a fixed loan now, you can afford the rate as long as you have a job, right? So like that won't be the issue because your rate's not going to go up. What would be the issue is you lost your job, or your job comes to you and says you have to take a pay cut. To me, that seems to be where the potential next housing crisis might loom, especially in a period where you've just overinflated the market for the last 18 months or whatever it's been. What's your read on the potential for a housing market, and where are the weak spots?
So when you look at the housing market right now, there's a lot of individuals that have tried to cash out. So they've taken their home equity lines. They've tried to they've tried to equitize, some of the value that has come into their homes. So when you look at that, that really is what created some of the bigger issues as well in 07 and 08, where you got to a point, and we got there, and now it's actually starting to pare back, where you had waivers on assessments where you didn't have to appraise at that value. You had waivers on income proof. You had waivers on a lot of these key pieces, and that started to pare back a bit. But now you have these homes that have this inflated value based on comps. And so people have gone out and said, okay, well, I just got a notice saying that there's $230,000 additional equity on my home. This company, pick your bank, is going to give me $150,000 at an introductory rate at this level. I can go do XYZ with it. So now you have a situation where what happens when that equity goes away? Now this is when you start to come underwater and you start to see that pressure. And that's what we're starting
So the
to see
HELOCs,
a bit.
more specifically, is what you're saying, right?
Yes.
Okay.
And the problem is when you can't
Good point.
turn around and sell it to the same
Yeah.
in the same way. And let's be fair, taxes are going up. So
Mhm.
not only are you going to face this rising value, but as your tax rate increases, the resale is going to be much harder. So when you look at that resale, yes, you can say that there's low rates, but you still need the down payment, and that's where the crux of the problem really comes into play. Of, do you have that down payment? So when you look at the lack of starter homes, the drop in the increase of, from, let's call it $240,000 to $340,000 in terms of just the median home price. That's you're taking away the bottom layer, and you're increasing the amount of 700,000 and above homes. That is just pricing people out of the market. They can't build the equity. They can't try to build out. But the other thing, and we've come into inflation and some of these different pieces, and you go back to the 70s and 80s, and people always say, well, look at mortgage rates. Mortgage rates were 17%. It's like, that's true, 100%. But your money market account was 14%, and your savings account was 12%. So you actually made money keeping in the bank. So the spread between the two really wasn't that wide and given this also brought down the price. So now you look at this, if you have a money market account, you're lucky to get 10 basis points, and your mortgage is for 3 3/8 or 4%, and this is it's fine. But when you start to come to the other side, as taxes go up, as rates start to creep higher, all of a sudden trying to sell that for more than what you bought it for is going to become very difficult.
Yeah, the HELOC. I haven't thought about that. That's a good point, because a lot of things that you buy with a HELOC, you can't get your money back out of really easy, right? So you could go buy a car because it's a better rate potentially, but okay, you're stuck with a car. You can't get your money back out. If you do a home improvement, then you had to get the equity. You put a pool in. So yeah, that's a good point. I haven't thought about the HELOCs and how they could impact it.
And then take it to the next level of volume, right? So you had a moratorium on evictions, you had a moratorium on foreclosures. That's now ending. So how much supply is sitting behind a false gate, and all of a sudden this expires, and now you have a new wave of supply that's coming out, and they just want to get their money back. So they're not really looking to make money on this. It's that I just need to get back what I lost. And I think that's where you could start to see some of this carry forward of, what does that market look like as Case-Shiller comes out, up another 18%. You're seeing just these foolish moves, but that always bleeds down to, what is your rent going to be? How much is rent going to cost? And that's where, some of the stickiness comes into that CPI calculation, because rent and home ownership is, 42% of that calc.
Yeah, we were lucky enough to get out of the house, make a nice profit, and then the rent after HOA fees, their old place, and insurance and stuff is basically the same. So we kind of were able to make a pretty much usually if you sell and rent, you're going to pay a pretty premium. So we were able to kind of get the best of both worlds, and so hopefully the market will open up. I don't know, maybe 2 years, year two. What do you think? 2 years? How far out?
I've always been saying 18 months to 2 years, just because it's going to take time for this to happen. I mean, when you look at what it was in 06, when you think about from like 01 through 08, you're not seeing, obviously you're seeing building, but not at the same rate. We are relatively short housing when you think about volume, but we're long in the million plus, the 700 plus, and we're short in this one area. So essentially we're oversaturating one side of the market, and then you have this undervalued side. And this is going to create, I think, an opportunity realistically to maybe build some of the lower end homes or some of the starter homes, and maybe you start to get some of this pivot that might help alleviate some of the pressure. But you did get that move from the urban to suburban to rural. So there's still some of that conversion. And then that comes into car ownership. The average car now is over 12 years old. At this point, I think it's sedans are 13 years old on average, with I think it's SUVs and pickup trucks at about 11.1. So this is going to be that next conversion, because everyone's like, oh, used car sales are going to come down. look at those prices. It's like, well, we're also coming into a fairly big conversion point, and there's a lot of supply chain issues. So when you look at some of this underlying cost, but you only move once, that's why we're starting to see those durable goods come down. You will see some of those car prices abate, but I don't think they're going to move lower to the point that people are expecting, which is going to keep that inflation calculation, that inflation, giving way into that stagnation in terms of instead of coming back to normal.
So let's talk about humans. you some of these other maybe think about this. I'm pro-human, so I like humans. Maybe we need more humans. You're starting to see kind of this narrative. China a few months back said, "Hey, let's go to the 3 China policy." And then I was trying to find the article, I couldn't find it, but I think it was the Wall Street Journal or somewhere today ran an article talking about the U.S. Demographic problem. Europe, there's a great book, What to Expect, No One's Expecting. It kind of breaks down the problems in Europe. What is your read as you kind of look for a aging demographic with the boomer generation in the U.S.? There's plenty of people at the high government level who are saying, hey, if we don't start having more humans, we're going to have a problem in the next 30 to 40 years, maybe a little bit further out than that, but it's coming. Do you buy into that? You disagree with that? What's your thoughts on that?
So it's, when you look at it in a bubble, the going rate is you need the average woman to be having 2.1 children to keep constant. So you need, and then anything above that, as you start to get to 2.3 and above, that's when you start to have, obviously you're not having a third of a child, but you get the idea in terms of averages. Right now we're at about 1.7, but America is still a place that people want to immigrate to. So when you factor in immigration, when you factor in people still coming to this country, we're still growing in all the right spots. Because when you think about where there's a very young populace, you have to look to parts of Latin America, parts of Africa, parts of the Middle East. And there's a lot of migration that's happening, especially people that have the means to do so, from those regions and into others. But when you look at other areas, and you brought up China, that's a big problem, because China is not as receptive to immigration. They're not as receptive to having those individuals coming in. So it becomes an internal problem. And this is one of the things. We did a show on this, and I think it was the Financial Times did a deep dive on it. I know Trivium did. There's been a bunch of different papers and consulting groups that have shown the hidden costs of having a child in China. And even though school is free, it's not. Like, they talk about the bribery, they talk about the needs for education, further other education, and they're now cracking down on that. When you look at the tutors, the private side, because there were all of these hidden costs. And that really came down to, even though you're telling me I can have more than one child, I can't afford more than one child. So yeah, okay, you want me to have 3, but I can't afford it because of the bribes, because of the tutoring, because of the extensive things I need to do to get this individual into the best school possible, to get into this school at this rate. And that becomes a big overhang. And that is one of those hidden costs. Now, take that to the other side, and we come to the jobs market, the wages market. And when you look at China, there's been a very slow wage growth at a broader level. You can say that, oh, well, they've lifted everyone out of poverty. One, they've moved that goalpost several times. So their goalpost of poverty has shifted down. But there's also medium wage growth has been there, but it's still not enough to incentivize or afford that additional child, that additional individual. And that's become the crux of the issue. And the U.S. has more opportunity, a bit more land, a bit more growth and openness to immigration that others have, which is an issue we've seen in Japan countless times. They're on a shrinking side. Same with Russia, where China is going to have to make a decision. Are they going to become more open to immigration, or are they going to have to try to find a way to incentivize and support this? But when you look at their debt levels, when you look at the stimulus they've tried to put through on consumers, investments, all of these things, they're just not in a position to stimulate the same way that they have, and that's where I think you're going to start to see the pressure points. Now, carrying that into pension funds, that's I think the bigger issue that doesn't get the press it deserves. It did in '08, but then it kind of went away. When you look at, well, how are you going to pay into this? Because now we're at a point where 6 to 7 people are taking out of it, where for the 2 that are putting in. So when you look at this shift, this comes back to housing and the rise of property taxes, because you're going to have municipalities, states, federal government that has pension funds that are underfunded. You can't make any money owning a treasury bond. So you're in these risky assets that might go belly up, might not, but you're going to have to pay these individuals out, and you're not getting that payment in, which that is where you're going to get the bigger problem over the longer term as these pension funds whittle down, and you just don't have as many people paying in to keep that going forward. Because in the 60s and 70s, for every 2 people you had taking out money, you had 5 or 6 putting it in. So you were working in on a strong footing, and we just don't have that. It's actually completely flipped at this point.
Well, you have yes, agreed. And the other thing is that when you think about service industries, if you don't have a lot of humans to handle service, then you have to have some kind of technology to overcome that. And
Right.
so at McDonald's, you might say, well, there's a kiosk there, or at Walmart, there's a checkout thing. But when you talk about services where you want human to human contact, like nurses, doctors, stuff like that, physical therapists. If you're not careful, you will find your plumbers. You will find yourself in a spot to where you don't have enough trained people to handle these jobs for the population, and these services will be in high demand, which will cause its own problem. Which is why I always had a problem with Thanos wanting to snap in Marvel. It's like, okay, listen, if you're going to cut out 50% of the population, we've got to talk about which 50% you're cutting out here, because if you accidentally cut out all the plumbers, we've got a problem here. So we need to ratio this out properly.
And that's where we're starting to see the pivot go back, where you're incentivizing people going to trade schools. You're starting to see that move, because it's just not worth coming out of college with $175,000 in debt to do what? Like what is your skill on the other side? Where if you're a plumber, if you're a welder, I mean, you can come out making $85,000, $90,000, and the company that picks you up, or the apprenticeship, they either covered it, or maybe you have a few $1,000s in debt, and now you're instantly making money and you're starting to build your craft. Look at our infrastructure. Look at the need for the infrastructure bill is real. Yeah, unfortunately, it's going to have so much fat in it and other types of pork that it's going to be disgusting. But realistically, we need it, and we need people to carry out those jobs, to carry out those needs. And I think that's going to be this big movement. And I think that's going to be an exciting opportunity, because hopefully it brings some of the college costs down, because now you're going to have to compete more readily and attract some of this. But it's going to put more plumbers to work, more electricians out there, more welders. And I think that's something that we need. And let's be fair, it's a good job. It's a well-paying job. It's physically demanding, yes, but there's opportunity on that. And there's a lot of things that can be built off of it. And some kids are good with their hands, and they're not really great at school, but that doesn't make them stupid. That just makes them good at something different. You can still be intelligent and not want to read Shakespeare. It's okay to want to pick up a wrench and play around with an engine. That's okay. We need to incentivize that, because that's where there's someone that can make a good living, that job is now in higher demand. And I think we need to cultivate that, instead of saying, oh no, put that wrench down and go get a liberal arts degree, where they're not going to be happy. They're not going to be satisfied themselves. They're going to be depressed. Look at depression, look at all of these things that are coming up as we're trying to dictate, let someone tinker. They'll come up with something really cool that we never even considered. They'll come up with a new process, a new assembly line, a new machinery. Like, we need to let innovation and the business cycle take its place, and incentivize these kids that don't really like to read all that much. Not to say that they should be illiterate, but if they want to pick up and go to a trade, more power to you.
Well, okay, you hit on kind of a sensitive spot there for me. It's so agreed. The first off, we need to let the market work in the market. And what I mean by that is you have to quit, to your point, over incentivizing people to go to college. Here, take this really cheap loan that no one would give you for anything else,
Mhm.
but go spend, $75 to $150,000 on college. But whether or not you can get a job to cover this or not, no one would give you that type of loan in the real world
Right.
at 18 years old. And yet for college, we just boom, sign it blank check. So we need to let the market compete to where plumbers, electricians, welders are actually able to compete with kids coming out of high school, trying to recruit them. Whereas instead of you get a 4-year party degree, and you get a bunch of debt. So I agree 100%. The second thing is, and I saw the Biden administration, kudos to them, is working on lowering the barrier of entry. I don't know to what all of industries they're trying to work on, but they're trying to lower the barrier of entry. This is something that's I'm a big advocate of. I was listening to I had Carol Roth on the podcast, The War on Small Business, and in her book she details, I think it's Indiana or Illinois,
Mhm.
The law on braiding hair. Like you had to get licensed to braid hair. I mean, it's ridiculous. It's stupid that you had to get a license to braid hair. I mean, I braided my daughter's hair at the house here before.
Right.
Thankfully, I didn't need a license. And if I did, they can come arrest me because I'm not getting one. But you just stop and think we've gotten to the spot to where to braid hair. Now, I'm not a plumber. I'm not an electrician. I don't want to speak about those industries as if I have the practical knowledge to say what the barrier of entry should or shouldn't be. But what I do know is the industries where I have observed testing and standards to get in. Usually, those testing standards aren't very good. They're very
Mhm.
minimal. You have to be able to pass a test. That doesn't mean you can actually wire. Like an electrician doesn't mean you can wire a building in land surveying. It doesn't mean you actually survey. You can answer the questions. You can't actually solve the problems that you will find in the real world. So back towards the more apprenticeship model. I'm
Yeah.
a big advocate of that. That's where we need to get. And the final thing is, in the age of the entrepreneur, why don't we allow more plumbers to come out to be entrepreneurs? There's nothing wrong with being a solopreneur as a plumber or
Mhm.
having a handful of your buddies come work for you. And so those are the types of things that I think that you're dead on. And if you want to build a middle class back, we said the middle class is eroding, start there.
Yeah. And allowing them to build equity in things that don't require a Robinhood account, and actually building value that they can earn by putting money in and actually being smart with their capital instead of just YOLOing on some Tesla calls. Like we've created this negative feedback loop that needs to be broken, and it's going to hurt. And that's something like when I talked to my father about the inflation and some of these things, that conversations that we had, because I said to him, I was like, when was the last time you really were concerned about inflation? And he had to think about it. And he's like, probably 81 to 83 was the last time I was concerned about it. And you think about what Volcker did, and Volcker comes out and says, look, I'm going to cause some pain. It's going to hurt, but it's going to be for the long-term sanctity of and security of the economy. Now, there's things that he did in terms of changing the way some of the calculations were to make them look better. I'm not saying that he is, everyone has their faults, and you can always look back and emulate only the good things. But let's be fair, like there's always good and bad. But he had the right idea of how do we create a long-term future with what's behind us. And it's always letting the business cycle work. Like, don't protect zombie companies. Like, why do we have companies that are borrowing billions of dollars and making nothing, like in terms of revenue? Like, that's not a sustainable model. And we need to really loosen up, because we need to make that capital available to the entrepreneur. You need to get someone who's going to say, look, I'm going to invest in that guy because I believe in him. I think he has a good head on his shoulders. He has good skills. This is going to work. And you just don't have that. You have it tied up in some of this garbage that just really has no life expectancy outside of it's a way to play the Fed game until that game is over.
Okay. So I had a thought and I lost it. You said something really smart there, and I was going to ask you. God, you were on a good riff, and I was like, okay, I can ask about this. I don't know. I'll have to come back to it.
Sure, but but to kind of continue on that, like some of the big things right now is really going to be what happens with the Fed going forward. Like, what now do we have with the, we talk about the RRP or the reverse repo, you have billions, hundreds of billions of dollars just, leaving the market, but that has to come back. Like, people look at the RRP and say, oh, well, the liquidity's gone. No, it's not. It is temporary. It's temporarily moved into another location, but it always comes back in because those are the bank's liabilities that they're parking somewhere. So when you look at what the Fed continues to do of 120 billion a month, when you look at the mortgage-backed securities they continue to buy, why? Like, why? What is the rational goal? And we all know what it is. It's propping things up. It's whatever mantra it is of the day. But we know at the end of the day, it's because they can't stop, because they know the moment the momentum turns, we're going to face a much bigger problem.
Oh yeah. You have to keep it. You have to keep it going. That's good. God, I had something I was going to ask you, but I cannot remember. Let's talk about China, because
Sure.
we've got plenty to talk about there. First, let's break down the floods. What's going on there? You've talked a lot about the crops in China, the droughts. What's your read on the floods, the dams? There's a lot to unpack here. I'll let you kind of take it from where you want to, but let's also hit the long-term impacts. Will this have any positive? I know there's traumatic loss of life, so I wanted to mention that. But will this refill some aquifer somewhere that may help them with their crop production, or is it just too fast, too furious, and it's just gone?
Well, and I think you bring up the last point is key. It's too fast, too furious, and this is the issue that we always come down to, where there's some locations that within 3 days got their annual water flow. Those are the types of situations where the soil, the aquifers, the rivers are just not, they don't have the capacity to handle that kind of volume that quickly. So then you create landslides, you then saturate and destroy crops, because when you flood crops to that point, the crop dies, there's rot, the root rot, there's all types of situations that become a much bigger issue. So when you look at the crop side, that's where now they were expecting to see a much bigger yield. They were expecting to see a bit, I don't want to call it a bumper crop, but a more normal yield versus what they had last year. And now those visions of normalcy are completely washed away, no pun intended. And the bigger issue now is it's becoming more prevalent. And that's the bigger concern, because a lot of these dams were built to create reservoirs to try to build up some of this capacity. And they really weren't meant to handle this continuous flood water that's trying to hold back. Like, there are several dams that are completely fully open. They're not even trying to slow down some of this capacity because they just physically don't have the means to do it without creating structural failure. And that's, we've already seen several dams have structural failure to the point of complete collapse. And this is going to become a much bigger problem, because the issues where a lot of the provinces that are seeing these areas. So there's something called the LGFVs, which is just essentially local government, financing vehicles. So a lot of these provinces that are seeing massive flooding and the destruction of crops actually have to roll a lot of that debt. So not only are you having to deploy capital to help those in need, to try to save people, fix things, but you're also going to lose tax revenue, because these are the people that can't sell crops. Instead of actually selling the crops, you're going to have to provide crop insurance. Instead of seeing some of these facilities that are going to throw off, $20-30 million in tax revenue, now they've been shut down for 8 weeks, and they're going to need to replace everything on the machine floor, because it's all water damage. So all of a sudden you have a much bigger issue in terms of what they're going to be able to do on rolling that debt, getting new debt. And that's where the government has to step in and say, look, we're going to provide some financing. So when you look at the RRR cut, or the reserve requirement ratio, that was more along the lines of providing enough liquidity to backstop the banks, not so much to stimulate the economy. And I think that is lost in translation, because we view the RRR as something a bit different. And that's where they're going to have to get more creative to provide that support, because not only are you going to see crop loss, but these individuals lost jobs, lost wages, and they're already struggling because they really haven't come out of COVID yet, or the COVID slump, whatever we want to call it, which is just going to be a even bigger drag on the municipality, provincial, and just federal government.
The Chinese, I think, are going to find themselves in a tough spot because it's easy. I'm reading Peter Martin's book, China's Civilian Army. I don't know if you've read that or not. Anyways, and he talks about kind of how they were handling stuff back through the Mao era, and it's kind of funny reading some of the stuff they did back then is the same stuff they're doing today. But anyways,
Right.
It's one thing if you're Kim Jong-un, you have a very small piece of property that you're managing, and it's extreme poverty that you're keeping people. So just above that is kind of the goal, right?
Mm-hmm.
Some will defect and want to run away, but by and large, you keep the top fat cats happy, the bottom cats just give them enough. What China did when they moved all these people from abject poverty into these super cities is they changed the game, and now you're at a spot to where these people, just above that, won't work anymore. They want to kind of have their current standard of living. They want to live where they're at. They want to maybe get something nicer, or they may say, well, if the government did this, I don't really want to work that hard because the government can take care of it. It's not the same when you're managing wealthy, and I'm putting wealthy, relatively speaking, wealthy people as it is people in poverty. And so you take a disaster, you take a COVID year, you take a shrinking population. I just don't see, I know people are scared to death of China. To me, they have so many things working against them. I don't see much about it.
Well, and then you look at the business side. So some of the biggest issues that we've seen so far, when you look at China itself, is on the micro cap, the small and medium cap companies, where they just don't have the funding. CapEx has been cut. They're not hiring. They're struggling under the pressure of not only just a slowing economy, but also the internals that we've talked about with some of these issues on employment, some of the issues on floods, where the large caps aren't seeing that same type of issue. And not to say that they're not booming, but they're also not struggling to the same perspective. And that's some of the things that the Chinese have, and the PBOC specifically, have come out and said we need to do more to support them. Which I still think that's where you're going to see some of the stimulus. It's going to be more targeted, just because they can't risk getting those credit impulses too high again, because they're really stuck with what they're sitting in, just because there's so much debt to GDP at this point. And then you parlay that into the US, and you look at what's happening in the US right now. It's something very similar. Like when you look at the mega caps, I mean, they're crushing it. Like they're fine. But then you look, you go to you drive down Main Street, you go to your local mall, and 30 to 40% of storefronts are empty, and there's really no chance in the next 6 months somebody's going to pick up that storefront. So you're seeing a similar backdrop. It's just, so we're having similar problems, but how we address it,
Sure,
I think, is really going to dictate how we're going to succeed or fail over the next 20 years. And I think this is why I talk about the Fed and where we are right now. We need to have a real gut check of, are we going to let the business cycle move its way through? Bankruptcy is okay. We've learned time and time again, it's okay to file for bankruptcy. If it's a good idea, you will get financing. You will get a PIK. You'll get a bridge loan, and you'll come out on the other side. And if it's not, you go into liquidation, and the people that provided that debt, I'm sorry, you took a risk, you lost. This is what you could liquidate with. Move on and do better due diligence. Where in China, they're trying to do something similar. They're trying to avoid the bailout. We look at Evergrande, you look at you look at Yorong, you look at all of these different things. It's just they're experiencing something similar to our 07, 08, where we didn't appreciate all of this off-balance sheet debt. And I think we've gotten smarter on that sense, not to say perfect, but smarter on that. And I think China's trying to wrap their hands around how much off-balance sheet debt do we really have. And I think they continue to be surprised at how much is sitting there.
How many tech billionaires can they crush though before that works against them?
Well, I think that's where, again, the innovation side comes through. And this is where, I mean, obviously I'm American, so I'll be a bit skewed on this, but this is where America has that capacity because we appreciate patents. We appreciate, the IP side of the equation much more than what they do in a Chinese type economy. And I think that's some of the things that, if you incentivize that, if you protect that, not to say I'm against having a conversation about breaking up some of the tech boom that we've seen in the US, but it's to your point on, you don't crush the people who created it because you want to incentivize them. You want people to build, create, do. Like, I'm okay with people getting rich on their ideas, because if they're getting rich on their ideas, it's because the market likes it and is willing to pay for it. Have at it. Like, I'm okay with that. When you try to skirt, taxes and take advantage of other startups, I start to have a problem. But I'm okay with people getting rich. Like, I mean, I'd love to get rich. I'm here to find a way to do that.
That's right.
It's just getting smart and trying to create something that somebody wants, some content or some product. And that's where China has been struggling. And now, Russia came into something similar. China has the opportunity. Do they either go more democratic or do they tighten up and become more communist? And if you look at the Deng's view, was let some get rich. That was his view. Let some get rich because we need that. And now they're pivoting away from that and playing up Mao and playing up the community and playing up, everybody benefiting. And they're essentially doubling down on communism, where they were kind of moving away from that. And now, as you start to see that pivot, I think that's where you're going to start to see those pressures coming in. And you'll start to see, well, if I'm Chinese and I'm getting my PhD at Stanford in, I don't know, biomechanics,
right,
am I really going to go back to China to invent something? Or am I going to stay in America? Or am I going to go to somewhere in Europe? Or am I going to go somewhere else in Southeast Asia? Because I might have family in Vietnam and I like where they're going. And I'm going to take my PhD, because let's be fair, a Stanford PhD is transferable. An MIT, degree is transferable. Everybody in the world is going to want you. So why am I going to go back and possibly get my idea stolen?
Okay. Agreed. Let's see if we got a question. How does Mark feel about the Olympics?
So I've always been an Olympics fan, and
Mark, come on now.
I've always been an Olympics fan. I've always appreciated it. It's just, when you look at what it was very forced. I don't think there was a lot of buy-in given where people sat in the world, but at the same time, I appreciate that it's unfair to the athletes, and there's something that has to be said about, these people want to compete, we want to see them compete, and we want to see them succeed and whatnot. It's just, we're watching the failures continue on the home country or the hosting country, and we have to really address, what is. Not to say that every country has to get rich on the Olympics, but it can't be the same type of drain. And I think we also have to be serious with how do we treat human rights? Because, on one side, we're sanctioning China for human rights, but then on the other side, we're welcoming them into the Olympics, where, and again, we can talk about, but then we can talk about the USSR, where we were then Nazi Germany, and so there's precedent where we look past some of this to try to create unity through sport. And unfortunately, I think that there's going to become a much bigger problem on a broader viewpoint.
Yeah, so we were on the show this morning and the Olympics came up. And I'm just not an Olympics person. So track and field, like the 100-meter dash, okay, I'll watch that. If Michael Phelps is racing in the pool, I'll watch him. But handball, surfing, rock climbing, it feels like they just went out and said, hey, we've got 2 or 3 cool sports. Let's literally try to get everything we can to make it Olympic sport, so we have something that's 2 weeks long, because most of these sports, listen, they're better athletes than me. They're more talented than me. I get all that. I'm not denying any of that. But let's be honest. You would never watch synchronized swimming on your Saturday off. You're like, well, let's turn on ESPN 27, and it's just they're irrelevant. So I don't really get into it much. Figure skating, I don't watch that. So the Summer Olympics, there's 1 or 2 sports. The Winter Olympics, it's like the basketball. I'm not going to watch the U.S. team play. I can't imagine they'd have to be like down by 10 in the gold medal game for me to turn it on, because they should win by 40. And so
But they lost, and it's
listen.
just. Well, that's why I do like watching the amateurs, or amateur is relative, but people who are just great at their craft. And I think that there is a lot to be said about watching someone who's great at what they do. And Simone Biles is one example of someone where, unfortunately, she got injured. She had trouble, and this will probably be her last Olympics. But watching someone that good compete, like, I don't care if you like gymnastics, don't like gymnastics, watching her do her thing is just amazing. And that's where, like, we watch fencing, and I'm watching fencing, and I mean, how often do I watch fencing? But watching this one woman, the U.S. individual who I think was the first gold medal the U.S. has ever won on men and women, she was unbelievable. And watching her at her craft was fascinating. Now, would you ask me, oh, Mark, it's a Friday at 8 p.m. Let's go watch collegiate fencing? No. But watching this person that you're seeing this, like, and I mean, I couldn't tell you the first thing about fencing, but the way she was parlaying, the way she was moving her feet, you could tell that she had the edge. And just learning something like that, and watching people come together, is a nice thing to try to teach, especially when you look at, what's coming and how things are shifting in the world today. And I do like watching the Australians and the US get together and compete against each other, but I'm actively rooting against some countries more than others. But, it is what it is.
Yeah, I suppose if I had kind of a group of multinationals and we could sit around and go at each other during a fencing match or a surfing or whatever, that would make it a little bit more fun. But no, I just don't get into it. When I was younger, much younger, I used to, but then as I've gotten older, I just, and the other point you make, explain something about Big Orton. Big Orton watches my podcast, and I've wondered why. But as you just said, to hear someone who's so great at their craft, you have to tune in, and so that's why Big Orton is a watcher of this program. He sees the master at work, and he can't help himself, and so I've wondered, but that explains that. So
it makes sense.
Yeah, that's just, so thanks.
As you say, you're a good talking head, so that's important.
That's the only thing I'm good at. So, okay, Mark, I'm gonna let you go with this. Give our listeners a book to read between now and the next time you come on. I know you got like a stack of 5 billion, but this,
I'm trying to. Trying to think of the one that I'm reading now, or one. So this is one that I've told everybody. And I think it gets to what we've talked about, is Prisoners of Geography. Prisoners of Geography is the one that I would have everybody read. Those that when it's one of the better books, the best books I've read in the last 4 years, because I think it really simplifies how tribes were formed, how geography shapes those tribes and those, the natural resources, speaking to droughts. There's a lot that comes into waterways, how important waterways are, fresh, ports in terms of port access, mountain ranges versus plains. I think that becomes very important, especially when you're looking at simplifying things to simple stupid on where does the world go? Like you talked about war, things that are hard to predict. But I can assure you, when people can't drink water or eat food, they are way more likely to go to the most extreme level possible to address their failings or their shortfalls. That, if I can go across this arbitrary line and kill that guy and take his food to feed my family, that's why that quote is always one of my favorites, where, I don't hate the man in front of me, I just love those behind me, really speaks volumes when my family can't eat. And I think that's a very good book to introduce the importance of arable land, the ability to, like, the 15-inch line within China and the problems, because a large part of China is desert, frankly. And that becomes an issue to feeding the largest population in the world. And when then you talk about people that were moved to that urban setting, well, a lot of that urban setting is on the arable land because, shocking, where you can grow food, you can also grow humans. So there's a lot of reasons why you have that situation. And I think Prisoners, it's written by a gentleman who I believe is a Wall Street Journal.
Tim Marshall.
He writes. So it's written it flows very well. It's only, I think, 250 pages. And I think it simplifies things to their most basic grassroots level. That is something.
Series. There's 4 of that series, right?
I think so, but Prisoners of Geography is the one right now. And then we can get more in depth on trade wars. There's a trade wars book that I'm reading right now that I got for Christmas, and I'm just finally getting to it. And then I'm actually reading one that is it's by the gentleman who wrote The Devil in the White City. I think it's called The Vial and the Stand, and it's about essentially
Eric Larson.
Yes, Eric Larson. So it's his most recent book about the German offensive against the UK and Churchill.
Man, his book, Dead Wake. Have you read Dead Wake?
Yes.
Oh God,
yeah, it's fantastic.
Go in the water. It's like it's like the water. It's so. I listened to it, and so you got a narrator, and so it wasn't dramatized, thankfully, but just the stories of people going in the water and just how brutal that was. Oh man, it was a great book,
Yeah.
But he did a good job of actually bringing you to the moment of what happened there. So okay, all right, with that, Mr. Rossano, tell people where they can find you at.
So you can find me on Twitter at MarkFNY. You can find me on my YouTube channel, which is Primary Vision Network or PVN Network, or you can just reach me by my email, which is mrossano@c6capital.com.
All right. Well, Mr. Rossano, we thank you again for your monthly appearance. Look forward to seeing you again next month, listeners. Thank you. We did this live on YouTube. I'll link to the YouTube. I know we don't really push YouTube stuff much, but we're trying to push it a little bit more. But anyways, so for the audio folks out there, if you want to see my beautiful face or Mark's young face, Mark looks really young today, I told him.
Didn't need a haircut. I'm going right after this.
We'll link to that in the show notes, and we'll talk to you next time.
Sounds good.